Like many companies with a retail presence, GameStop was not doing so hot during 2020. This chart from the New York Times shows the evolution of some industries that were really perceived as lockdown losers, COVID underperformers, and including GameStop, how they've done in the course of 2020. Because they were perceived as overvalued, hedge funds took massive short positions into these stocks, and from what I realize, a lot of people are confused as to what short selling means. So the objective of this video is to explain in a very short but hopefully very effective way. Short selling means selling a security when you don't have ownership of it. So simplistically, this is how it works. Let's take as an example Starbucks. Starbucks is now trading at around $97 per share, but you believe that this is way overvalued and Starbucks should actually be trading around 40, which has been the medium-term moving average. So what you're going to do is go into a broker and ask to borrow one share of Starbucks. Then you go to the market and you sell it. So you're selling something that you borrowed, you're exchanging it in the market for $97. Let's assume that after a month or so, the share price of Starbucks actually goes to the value that you predicted. So it goes down to 40. In that case, you can buy it back from the market with the 97 that you had. You're going to give it back to the broker. So you're going to close that position. You don't owe it anything anymore. And you have collected in that way a profit, which is 97 minus 40. All great, but what happens if actually the market goes against you? So you short sold the stock of Starbucks, which you thought was overvalued. But then actually after a month or so, the price goes up to 120. Well, in that case, there's not much for you to do than to buy it back from the market at that price, because you have to close your open position that you had with the broker. But in that case, you're going to make a loss of 23, which is 97 minus 120. So that means that when you are selling something that does not belong to you, you can potentially incur in very huge losses. Hedge funds thought that GameStop was overvalued, then it should be worth less, and that's why they were shorting it. On the other hand, a group of retail investors interested in gaming, they started a buying program using a Reddit page to coordinate. And as a result of that, the share price rose by 1700% at some point, which is a huge development in such a short amount of time. Now the question is, what would you do if you were one of these hedge funds that has an open short position in GameStop? Would you close it now? You probably would not, because this means incurring into huge losses. You would rather wait for the share price to normalize. That means for the share price to go down. I personally think that there is a chance that hedge funds may win, because when something goes up in this parabolic way, rarely goes down sideways. It just goes down as dramatically as it went up. And that is because the temptation for some people to sell it, it's very high now. Imagine that you were able to buy it at the beginning of the year when it was trading around 20. If you sold it now, you will be making a profit on each share of 1600%. That pressure at some point for some small investors might become too strong, and they might start to sell. At that point, that triggers a mechanism by which many other people will want to sell their position, because nobody wants to be late to that party and be stuck with something that suddenly has become worthless. I hope this video was useful, and now you have more of an understanding of what short selling means, what it entails, and why people do it especially. If you have any questions, feel free to write them down in the comments, and in the meantime, I thank you very much for watching this video, and I'll see you guys soon.